Over the last 20 years, commodities have gone from a meaningful part of the global indices to almost an afterthought. That raises a simple question. If something disappears from portfolios long enough, does it eventually come back? I'm Matthew Williams of Williams & Associates Wealth Stewardship, and today I'm joined by Jeremy Lin, Portfolio Manager of the Purpose Global Resource Fund, to talk about what he's seeing across global resource markets. This conversation was so good, we split it into two parts. The first part is public facing, where we talk about the big picture, the commodity cycle, and the opportunity generally in resources and what might be happening beneath the surface. Then in part two, which we will share privately with our clients and our close network, we go deeper into how Jeremy is actually positioning the portfolio inside the resource space today, and why we should be very excited about kind of how he looks at the portfolio and the roadmap ahead. So let's get into it. My guest today has built one of the most decorated track records in Canadian resource investing over the past few years. Today's conversation has two parts. The first is for everyone, and the second is an exclusive discussion for our clients. Jeremy Lin manages the Purpose Global Resource Fund, and frankly, the results speak for themselves. Jeremy, welcome. Please tell us a bit about yourself and Purpose Investments.
Sure. Yeah, thanks for inviting me. So I'm a portfolio manager at Purpose, where I run the Global Resource Fund as well as a number of our fixed income products. I've been with Purpose for over 8 years now, and been in an industry for the past 15 years.
Oh, great. And on the piece around the Global Resource Fund, if we kind of take a step back, I've highlighted to clients in a memo that commodity weights in major indices have declined really over the last couple of decades, and when at the time I'd been writing that, it was pretty much at the lowest that they'd been in a long time. So if we take a step back and we think of a typical balanced portfolio and what we think underneath the labels, what do you think is quietly missing?
Yeah, and that's a great question because, even for myself, if I look back at my own personal investing, my personal portfolio has been 95% in the resource space over the last couple of years. But I think one way to kind of benchmark what a balanced portfolio should look at today is actually just the S&P TSX composite index, where, like you mentioned, about maybe like a year ago, some of the key commodity exposure, including energy and materials, have been at their lows. But just given the run up over the past year, we're starting to see a pretty good portfolio mix here, where within the S&P TSX composite, you're looking at about 30% financials, where Canadian banks have held up great, and you're looking at energy index kind of back up towards the 15% mark and trending higher, given all the geopolitical events that's kind of playing out in the world, and materials at a healthy 20% weight, given the phenomenal run last year. So if I was kind of like a new investor coming into the space, this is actually a pretty good mix, going into what I think will be a volatile space across the entire market, just not just within the resource space particularly. So that's certainly a good benchmark to start. In terms of what investors could be missing by underweight commodities in this part of the cycle is, number one, I think you're really just missing a lot of potential upside going from here, where I think we're really going into a super cycle where you have many different commodities that's going to work out, and that's likely to work out, and each of the commodities has kind of their own supply and demand dynamics, versus just historically in the past, where maybe one or two commodities are kind of the theme of the year. So now we're looking at gold, silver, copper, the energy trade is back, and looking forward to 2027, 2028, lithium and nickel, they're kind of down the pipe. So there's just so many opportunities within the resource space, and I think any investor should have some exposure to that in today's market. And in terms of how you think about the resource space versus the rest of the market is, it's also a great diversification tool, away from some of the high flying sectors in the past. So, as an example, you look at Nvidia today, they're still trading at a 32, 33 PE, or you could buy Barrick, one of the largest gold producers, at 7. So if there's a big movement away from growth into value, this is kind of the most obvious trade. And I still, I'm a big believer that in a couple years' time, everybody's going to look back at 2025 and 2026, and and think that gold equities is the trade of this cycle, where it's going to be a very obvious trade in hindsight. But yeah, I'll kind of leave it there.
Right. Thanks so much for covering. And you touched on a couple of things, like in a note that I had sent to clients around our positioning, which includes your strategy, and we'll talk about that a bit later. But I did say, there's the upside for people who are looking for higher returns. Like, this is a good, resource is a good allocation. As well, though, for people who are a bit more defensive, maybe it's a smaller weight, but it's going to drive diversification. You kind of hit on both of those pieces there, so it's kind of proving my case out. Um, but you also mentioned a piece there around geopolitics, and of course here we are in March. March 11th is when we're having this discussion. I don't know when this will be publicly available, but geopolitical changes. It's a topic du jour, at the moment. And but so there's what's happening in the moment, but there are also structural, forces converging. So in your view, like, what are those structural forces that are converging, and why does that make owning real assets, commodities, so on, and resources, meaningfully different today than maybe a generation ago?
Yeah, so a couple of things here. I think the major kind of geopolitical event that's ultimately driving valuation in the resource space is really this de-dollarization trend that's kind of been happening. And, a lot of the, turbulence that's kind of, led by the latest Trump administration is probably expediting that shift away from the US dollars. So if you look at a resource space where a lot of the commodities have historically been kind of priced by the US dollar, a lot of that, you're going to see a lot of that tailwind, just with a lot more countries starting to look at kind of their own supply chain very carefully, starting to kind of move from a just-in-time model to just-in-case. So really stocking up on a lot of critical minerals. So that's kind of a big shift amongst kind of countries around the world. And gold is kind of the perfect example where, you know, since the Russian invasion of Ukraine back in 2022, where the US and its Western allies confiscated Russian FX reserve, that's kind of led a lot of countries around to question, it's like, does that mean if we don't believe in Western ideologies, and there's a chance that your assets offshore might be locked up? So we've kind of seen a continued kind of resurgence in buying of gold as part of their of central bank reserve around the world. And we're starting to see a lot more kind of not your usual suspect central banks starting to come into the market. Just last couple of months, you see Brazil come in with a pretty big check, 1.5 million, 2 million ounces there, and they haven't bought gold since the early, maybe 3, 4 years ago. You see countries like Guatemala, not a country you expect to have be buying a lot of gold. They came in and bought 200,000 ounces. We're seeing this new phenomenon where Tether is starting to be a notable player in the gold space, where they're a consistent buyer of gold. And right now, I think they're probably ranked 25 or 26 in terms of their gold holdings amongst all the central banks in the world. So we think this trend will continue to play out over the next, 5, 10 years. So this is kind of just like the tailwind, just within the gold space. But I think a couple other things that's different today versus the cycle like 10 years ago is, number one, interest rates are much higher. Like looking at US 10-year, right now it's like 4.1. 10 year ago, it's about half of that, right? So when companies and investors have access to cheap capital, you start doing stupid things, right? So
Right.
in this part of the cycle, I think people are, management team are going to be a little bit more prudent with their capital. Number two, management incentives overall was also a little bit different 10 years ago. Energy, as an example, back during kind of the frac, the shale boom, a lot of management teams were compensated by how much they're able to grow their production, not cash flow, right? So that paradigm has had a shift over the past 10 years where management team has to deliver actual free cash flow to shareholders, and that's been a pretty big focus for many companies, including energy producers as well as metals and mining producers. So generally speaking, going into the next phase of this cycle, I think overall, some companies will still do stupid things as valuation gets higher, but I think there's a bit more buffer this time around where companies are going to be more careful with how they spend their capital expenditure.
That's very interesting. And you you started off with the kind of de-dollarization piece, which is, one of the things that, is spoken about a lot in financial media and so on and so forth, especially as it comes to the gold trade and so on and so forth. But then those other two, are pretty, those other 2 points that you raised are pretty nuanced, especially around that last one around management prudence and, avoiding capital destruction from that perspective. Um, if we take a step higher again, though, if we think about like how would as we think of also the structural force for the resource markets, aside from de-dollarization, which I guess would also be deglobalization in a way, how do we also think about the energy transition or sustained underinvestment in resource production over the last 20 years? Like, how does that play into it? Is that more minor to those other pieces?
Yeah, no, that's definitely a trend that's happening where, within the metals and mining space, where over the last couple of years, we're just running out of discoveries. Like there just hasn't been any major discoveries in gold, silver, copper, and and for you to kind of get to, you know, for you to be able to meet all the potential demand, let's say for copper, we think copper prices have to move up a lot higher to really incentivize copper exploration companies to, really spend money and get funding to, do your greenfield expansions and brownfield, greenfield exploration and brownfield expansion. So that's going to be a theme that's going to play out over the next several years. And when you look at the whole life cycle of a gold project or a copper project, like from start to the first gold pour, this could be a 10-year, 12-year timeline if it gets built, right? A big
Right.
if, right? Um, so when I kind of look at the market today, it's, we had a probably a year and a half, call it, worth of bull market, as people would say, and a lot of questions is, okay, is this kind of the end? And I would say no, because supply response, it can't happen that quickly. So the way I kind of evaluate, okay, what's the opportunity here is just really looking at some of the timeline and some of the structural deficiencies with exploration over the last couple of years, where the entire industry has pretty much been underfunded for years, just given that, gold, copper, a lot of metals and mining basically just went through a 15-year bear cycle. And now we're
Right.
1 year into the bull cycle. So we're just starting to get funding from investors. We're just starting to put money in the ground. So I think there's a lot more to do here before we see, that supply and demand kind of shift to, more of an oversupply stance.
Great. I mean, those are great points. And I guess it kind of leads me into my next question, which is really around, you know, what is the cost to an investor of missing this period of time completely? Like, what does a portfolio actually miss, structurally or in terms of returns by not having at least some commodity exposure?
Yeah, like the most obvious one is, for somebody that had zero, metals and mining exposure last year, you would have missed out on like 150% move just based on like the GDX. Um, I don't think we're gonna see that again this year, but in light of everything that's happening in the world, if your kind of bogey is, this space is in a structural tailwind, we're certainly positioned for more upside move within the space. But you look at every thing else that's happening in the market where, economic numbers are starting to come in a little bit weaker in the US and in Canada. So on a relative basis, you're pretty protected because, I certainly believe that the resource space will fare better than than many other sectors in the market today. So number one, I think it's just the potential returns from what I think is, we're going into this super cycle for resource. And number two is more, almost as a, best defense is your, best offense is your greatest defense. And that's kind of how I see the resource base today, where, you're shifting away from sectors that might see some headwind going into, 2026 and 2027.
Right, right. And, really, I guess now to sort of summarize this first part of the conversation, you've touched on a number of things. One was valuation, kind of think of the tech space you mentioned, Nvidia versus, I think, Barrick as an example. We've spoken about de-dollarization, deglobalization, underinvestment, beginning, kind of coming out of a 15-year bear cycle. Like, there's all of these reasons that kind of stack up. But if you were to try to summarize to the audience, like why, in almost like a couple sentences, like why now is the moment for resource equities, what would you say?
Yeah, so, of the past 8 years that looking at this space, usually in a given year, there might be one or two themes within the resource space that works out better than everything else. But for the first time in my career, pretty much everything within the commodities, the resource space that includes energy, metals and mining, precious metal, base metal, everything is kind of working today, and everything kind of has their own reason for why it's going to work. So that in itself means, you're more likely to be right than wrong. Um, Whereas, in the past cycles, like, in pre 2020, it was a tough period for both energy and mining, and you pretty much had to pick the right projects to be able to outperform the market. Whereas in today's world, it's more of a macro trade where, we're just underfunded, undercapitalized across the board. So the setup is very unique in that sense. Um, so, and we talk about, kind of the whole sector just coming out of a very long bear cycle. So a lot of the generalist capital has still kind of stayed away from this space because, and rightfully so, because they've been hurt in the past. And, many small cap funds actually pride themselves on not touching energy. So I think that's going to
Right.
change, change this year. A lot of institutional capital, including the pension plans, are still staying away from Canada, staying away from mining. That might shift as well, just given the recent US Canada tension. And, you know, right now we have a new Carney administration that seems to be more focused on getting Canadian resource out of the ground, which I think makes a lot of sense. Like, politics aside, like, Canada is a resource driven economy. It doesn't make any sense for us to kind of bootstrap ourselves. So I think there's a lot more movement there from a political standpoint. Um, and energy, that's kind of been treading water over the last couple of years, kind of coming out of the COVID recovery. We're starting to see green shoots there, just, with the latest Iran US kind of conflict that kind of reminds the world that, there's probably a little bit more risk premium than what was priced in before.
Right.
So that's kind of, boosted the space and sentiment a little bit. Um, so pretty much, everything, majority of commodities I look at within the resource space is working. Um, so from a downside upside perspective, it's a pretty good setup today where, you don't need to swing for the fences, and you'll likely be able to kind of see some continue upside just through this kind of macro tailwind.
Okay. Well, that was great. So, Jeremy, thank you for that. And for the people watching this, we're going to move the second part of the conversation onto a private discussion that'll be shared with clients and our network, where we're going to talk about, the specific fund, the Purpose Resource Fund that Jeremy manages. It's fantastic returns, and what what we should expect looking forward. So we'll turn to that now.